What if I told you? The secret to building life-changing wealth is hidden in a 5-letter word. Not money, not lucky either. It's SMILE framework. This is the investing strategy of the legendary Vijay Kedia, the SMILE formula.
तो मैंने उसी को फिर वो गाना याद करता हूँ, जो मिल गया उसी को मुकद्दर समझ लिया, जो खो गया मैं उसको भुलाता चला गया। वो आपका भी फेवरेट गाना है। मैं जिंदगी का साथ निभाता चला गया।
He is the man who once didn't have money to buy milk for his child.
एक टाइम ऐसा था मेरे पास में, जो बच्चे के दूध के लिए 14 रुपए नहीं थे मेरे पास में, दूध का डब्बा खरीदने के लिए। एक ऐसा पोजीशन था।
Used nothing but brains, self-belief, and, of course, a little bit of Bombay Stock Exchange magic to create massive wealth from the Indian stock market. Our story begins in the bustling lanes of Kolkata. Young Vijay Kedia was just 14 when his father passed away, and the responsibility of the family stockbroking business fell on his shoulders. In the early 1980s, a young Vijay Kedia, with 35,000 rupees borrowed from his mother, he left Kolkata and moved to Mumbai with a heart full of dreams and a burning obsession for the stock market. He bought his first stock, Punjab Tractors, which was India's first tractor manufacturer and held a dominant position in northern India. Around the same time, the Indian government was pushing hard on rural reforms and farm mechanization. Kedia sensed this and bought Punjab Tractor shares at 35 rupees per share. A few years later, Mahindra & Mahindra acquired Punjab Tractors, and Kedia's investment grew from 35 rupees to 600 rupees, a 17x return. This was his first aha moment in the stock market and gave him confidence to dream big. Most people feel safer investing in large, well-known companies. You know the names: Tata Motors, HDFC Bank, Infosys, ITC. They're reliable. They've proven themselves, and they seem safe. But guess what? The real money, the life-changing, multi-bagger kind, usually comes not from these giants, but from their younger cousins, the small-sized companies. These are the hidden gems. They are often undervalued, ignored, or misjudged by big institutional players. Why? Because they're too small to matter in a billion-dollar portfolio. But to a retail investor like you and me, they are gold mines. Kedia's philosophy is simple. Find a small company today that can become big tomorrow. Think about his investment in Atul Auto. Back when he invested, the company was a tiny three-wheeler manufacturer. But he saw something: scalability, a niche market, and good management. Over the years, it multiplied manifold, because in the stock market, small size isn't a weakness. So, how do you know which small companies are worth your attention? Here's what Kedia looks for. Number 1, small market cap. Look for companies with a market cap below 5,000 crore. Why? Because that's where growth is waiting to happen. These companies are often family-run, still in the early stages, and often undervalued. Number 2, simple business models. Kedia prefers businesses he can understand. If the company makes auto parts, paints, garments, or sanitary ware, he wants to know what they sell, how they earn, and who their customers are. Complexity is not a virtue here. Simplicity wins. Number 3, room to expand. The company should have the potential to grow 5x, 10x, or even more. Maybe it's in a niche market. Maybe it's entering a new region. Maybe it's developing a new product line. The possibility of explosive growth is what makes small-size companies attractive. Over the years, one insight became crystal clear to him. If you invest in a company led by people who have walked the hard road, the chances of losing money drop drastically. Kedia didn't say high in experience. He said medium. That's important, because too much experience often brings rigidity, ego, or reluctance to change. And too little? That brings in mistakes, missteps, and sometimes overconfidence. Medium in experience is that golden middle. It refers to promoters or management teams who've had just enough years under their belt to make a few mistakes, learn from them, and still be hungry and agile enough to chase exponential growth. Imagine two companies. One is led by a young, passionate founder, zero experience, high ambition. The other is led by a 15-year veteran who's built 3 ventures, sold one, and failed twice. Which one would you pick? Kedia's philosophy says, go with the second company.
Second thing should be medium in experience. I will tell you, because what happens, like, let us divide experience in 3 parts. One is the experience of 5-7 years. Another experience, which is, I see medium in experience, could be 15 years, 20 years. And large means 30, 40, 50, 100, 2 generations, 3 generations, or whatever it is. I usually do not invest in any company which has a small experience of 5 years or 7 years or 10 years. Whatever I have done in the past, I have not invested in any such companies where they have small experience. Because my idea is this, until unless the management or the company has not seen 2-3 ups and down cycle, they are not actually, you can say foolproof. If you have not seen 2008, that means you are late actually. You have to learn a lot of things.
Okay, so now you're convinced. But how do you actually spot a promoter who's medium in experience? Here's how Vijay Kedia does it. Track record. Look for 8 to 15 years old company. Not too fresh, not too old. Balance sheet scars. Have they survived at least one industry downturn? Did they manage without defaulting? Consistency and vision. Are they still talking about growth, or have they settled into mediocrity? Skin in the game. Do they own significant equity? Are their incentives aligned with shareholders? Behavior in crisis. How did they react during events like demonetization, COVID, or raw material price hikes? Large in aspiration means to invest in companies with long-term, game-changing dreams. When Kedia invested in Sarah Sanitary Ware, it wasn't a household name. Most analysts ignored it, but Kedia dug deeper. He attended AGMs, he spoke to dealers, he looked into how management was thinking, and he found one thing: ambition. The promoters didn't want to stay in the shadows of giants like Hindware or Jaguar. They wanted to build a brand, upgrade technology, capture market share aggressively. That was enough for Kedia. He invested heavily.
सेरा सैनिटरी वेयर में अगर मेरे डिविडेंड को मैं जोड़ लूँ तो मेरी कॉस्ट 0 है, कॉस्ट है मेरी. तो आज के दिन अगर उसको अभी मैंने बेचा है 2 महीना 3 महीने पहले, 16,000 गुना रिटर्न दिया भाई मेरे को.
16,000 गुना?
16,000 गुना. मैं 16,000% नहीं बोल रहा हूँ.
हाँ.
16,000 टाइम्स मेरे को रिटर्न दिया.
हाँ.
तो कहने का मतलब है ये तो इस तरह के तो कई मिलते रहे.
16,000 गुना. आपने कभी सोचा भी नहीं होगा कि कोई स्टॉक इतना जनरेट कर सकता है जब आप लेने जाते हैं?
सवाल ही नहीं है. 16 गुने का नहीं सोचा भाई. हाँ, और 5 साल तक तो पकाता रहा वो शेयर मेरे को. मैं 3, 4, 5 में लिया, समझो 30 रुपये के भाव में लिया था मैंने उसको. ठीक है, 30 रुपये वाला शेयर वो फिर से 100-125 हो गया. आज की वो स्प्लिट कुछ बोनस आ गया 1-to-1, तो इस बोल कर उसको एडजस्ट करके बता रहा हूँ. 30 में लिया, 30 वाला 125 हो गया था, और 25 वाला वो वापस 30 रुपये आ गया. तो 30 का मैंने 125 में भी नहीं बेचा, 125 वाला वापस 30 आया तो भी मैंने नहीं बेचा. अब उसके बाद में मेरे को उसमें 175 रुपये डिविडेंड मिला भाई मेरे को. 130 रुपये के शेयर में 175 रुपये डिविडेंड मिल गया मेरे को, अगर आज तक मैं जोड़ूँ तो उसको. और वो शेयर का भाव 8,200 रुपये है एक्स बोनस, तो 16,400 का भाव है. तो 16,000 गुना मेरे को 16,000 गुना मेरे को रिटर्न दिया.
And the stock grew over 16,000 times over the years. Aspiration alone is not enough. Plenty of promoters make tall claims. They announce crazy visions, but they never execute. So Kedia combines aspiration with execution ability. He watches how management performs after they speak. Do they walk the talk? When you find a company where ambition meets consistent performance, that's when you back the truck up. In SMILE, E stands for extra large in market potential. Great companies stuck in small markets become stagnant, but even average companies in booming industries can scale if they get a few things right. To evaluate whether a company has large market potential, an investor needs to look at the following points. Is the industry aligned with a long-term social or economic shift? Take electric vehicles. A decade ago, EVs were seen as luxury toys or tech experiments. But look at the massive shift beneath them. Rising concern about climate change, stricter emission regulations, consumer preferences for sustainability, and technological advances in battery storage. Electronic vehicles are gaining traction now. Can the customer base grow exponentially over time? If a company is solving a large and growing need of customers in a way that allows it to scale fast, then yes, its customer base can grow exponentially. Are government policies supportive of this sector? Supportive government policies can accelerate industry growth. For example, in India, government initiatives like production-linked incentive schemes have boosted solar manufacturing and electric vehicles. Similarly, sectors aligned with national priorities like renewable energy, digital payments, affordable housing are receiving active policy support. Look for companies with operating leverage. If a company can grow revenues exponentially without a proportional increase in costs, that's where true profitability lies.